Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
The B team is back and is out this week. You've got me hosting. This is going to be a tech-heavy, stock-heavy show, and let's dive right into it. Unprecedented. Things that never happen in the market happen all the time. That's kind of an oxymoron, but it's absolutely true. And the rally that we're having off of the lows from the Iran geopolitical situation is unprecedented in its speed and fury and amount of hate and disbelief that's going on in FinTwit. Bulls, AAII, 31.7% bulls. That's the lowest it's been in the last month while the market is at all-time highs. That's a little strange. NAM, this is we watch two main sentiment indicators, and we show them updated every night. NAAIM is the active managers, percent of active managers, exposure to the market. It's at 79, and that's up slightly from last week, but way far away from the oversold or levels where you're really looking to lock some profits in at 100. NAM actually held up pretty well, didn't go as far as offsides as AAII did during this pullback. But the bottom line, and you can see the chart that I'm showing, and it's a big V-shaped check mark type picture. And it really, there's not a whole lot more that you can say about that. Let's talk about how that impacted us here at Revere. So we have levels where we get more and more defensive. The first one is a breaking of the 21-day moving average. Then it's the 50-day moving average. And we started implementing those rules back here at the beginning of March. Then we monitor the 20-week and 30-week, which are basically, let's go to the weekly chart here, which are basically the 100-day and the 200-day, or sorry, the 100-day and the 150-day. And then, of course, the black line, the 200-day moving average. Now, historically, the market gives, there's some indecision when you first break the 200-day moving average. We talk about all the time how this is our pull the ripcord level, but we don't pull the ripcord completely, because very often what happens is the market vacillates a little bit around this level. You can see it pulled back and broke below it once. Two tests trying to get back above it. Those both failed. Then we pulled back, and we basically were all out or fully hedged as of 3:30, the day before the end of the first quarter. The next day, we got a big relief bounce on some news. So the question is it time to go all in? And we've talked about this, and the answer is no, but in steps on the index side. So the first sign that we want to start putting some money back into work is the index is getting above this purple line here, which is the 8-day exponential moving average. Then we focus to the next level, the 21-day moving average. Then we look for an 821 cross. Then we look up to the 50-day moving average. And of course, we're on watch for the classic O'Neill buy signal, which is a follow-through day, preferably on days 4 to 7 off of the lows. And we got that on 4/8 with additional relief of the Iran threats, geopolitical situation, basically kind of seeking for this to go away, this whole situation to go away, or at least be alleviated. And since that gap up, which happened on the 6th day, that was on April 8th, the market has just continued to the upside. Now, every call that we've had, we have two major discussion calls a day between the team, and we were all wanting some sort of a pullback so that we could get additional exposure on. And we really didn't get it. We had 2 days after the big follow through day where we kind of went sideways, gave us a little bit of an opportunity. And then 13th, 413 blasted off to the upside. And leading stocks were absolutely participating in this, but a lot of them got extended immediately off of this 4-8 gap up because they were making some progress off of the lows before the follow through day. And we had been dipping some toes into the water. But this is actually the worst case scenario. And we talked about this with our expectations chart that we showed last week. This making the low right around 4% below the 200-day moving average, which is where we go completely defensive. The market's risky, and we're basically prepared for further downside. We didn't get that further downside. If you look back here to March and April of 2025, this worked out much more to our advantage, which is first you get this move below, and we got it. So this was very similar. This break and move back up to the 200-day moving average was very similar to what we got with the break and the move back up to the 200-day moving average here. But then with the tariff tantrum in April of 2025, we had another 12% move to the downside. And we miss all of that. There was nothing to miss this time. So this put us a little bit behind the indexes, and we will always, off of the bottom, we will always lag. That's part of the way our process works. We know when risk is the highest below the 200-day moving average. We know there's a little bit of leeway to give it, normally 3 to 4% or 2 ATR below the 200-day moving average. But we also know that we need to get back in if we don't break down. And that's what we've been talking about in our videos all of this week, adding additional exposure at low risk spots, just not arguing with the market. And we're now in ride the wave, our ride the wave process, which is just get out of the way, keep your hands off the keyboard, let the positions that you have, if they're going to continue to work, let them work, go higher. Don't be a hero. Don't chase, still look for lower risk entries. But we know we will get a pullback at some time, and that's when we will add more exposure on things that are pulling back in a healthy manner. I'm really speaking for protection. My beta is about 1.2, so we're about 20% above the equivalent of being all in on the S&P 500. Turbotection's at about 1.5. Turbo can climb up closer to a 2. Grotection gets closer to a 1.5, 1.6. As it's less aggressive than Turbo. But we're pretty happy with the way this has played out, even though it was a worst case scenario for us. We're right within striking distance of the S&P 500 year to date, and that's while eliminating the risk and minimizing the drawdown during this pullback. The market pulled back not even 10% at the bottom, 9.5%, I believe it was. Our portfolios had similar pullbacks from that level, and now we're bouncing off that. We're participating. We're taking the market at its word, what it's doing. And this really has been an incredibly hated rally. I saw so many doomsayers when we broke the 200-day moving average saying, this is it. This is the big one. You know, just like Fred Sanford and Sanford and Son. I know older listeners will understand that, but this is the big one. I'm coming to see you. And he's holding his heart like he's having a heart attack. It never happened. We got 2 ATR down. We bounced, and we bounced violently, and we added exposure in line with that bounce. And leading stocks have been acting great. By the end of the day today, the trend gauge will go to the coveted 4 green arrows, which means leaders. And the 3 timeframes that we track, the short-term 21-day, the medium-term 50-day, and the long-term 200-day, will all be green. And we hit that at simultaneous with the moving averages on the index being the way we want them. And that's the 8 above the 21, 21 above the 50, 50 above the 200-day. And now we let the positions continue to work and look for additional. We're always going to cut. In fact, the first 3 buys that I did after this buy up, I got stopped out on all of them. The last 10 that I've bought are all profitable. And we saw our breadth, our unofficial breadth indicator is the 33 stocks that we release in our watch lists every Monday, the Turbo 12 and the 21 over 21. And that told us all we needed to know. There were some sectors that got weak. Obviously, anybody that was in oils got stopped out, but leaders, tech leaders, and also some retail leaders acting very well and giving ample opportunity. We're seeing some things that haven't broke out of bases yet that are setting up very nice. We've seen some things that broke out and are pulling back that are setting up very nicely. And just stay tuned to our nightly videos and Todd's weekend review. We'll tell you everything you need to know to get prepped for next week. But 71.35 is where the S&P is trading as of 8 minutes before noon Eastern time on Friday. And that's the summary. There's no Dan here to interpret what I just said, but I'll just summarize it briefly as saying, ride the wave, keep your stops in place, let your winners run. This is how we outperform during strong uptrends, and we underperform off the bottom. That's part of it. We never catch the bottom. We'll never catch the top. But the process is sound, and the process is shared openly with everybody that follows us. More than 1,000 people each day tune in between YouTube, Twitter, and our website. And we're very grateful to the people that follow us and support us, and especially our clients that stick with us during the drawdown times and get rewarded when we pivot to the growth part of Growtection. So that's my opening spiel here. We've got 3 fantastic presentations. We're going to go to Connor first. He's going to talk about a theme that we're invested in both portfolios, and it's multiple leading stocks and an ETF to go with it. Take it away, Connor.
Yep. So, as the market's broadened out and we've seen this huge V-shaped recovery off the lows, this week has really, a lot of themes have been moving quite strong. And today I'm going to talk about space. And we got a question from a client this week just about owning different stocks. And I'm also going to talk about, the basket approach that we use to catch this theme in both portfolios. So the goal isn't diversification for the sake of it. It's smarter theme exposure. And that's kind of the main thing I want to emphasize throughout my presentation. And so you can see Don has UFO on the screen right now. And this is the broad-based ETF. So if you want a basket of space stocks, UFO is a great way to play it. It holds, different weights for different names in that, and it eliminates the single stock risk. And so you can see this chart is making new highs again today, and you can see the relative strength line trending up and to the right. And many catalysts for this sector. The stocks are acting great, and that's really everything we need to see. And then we just look for a low risk spot. And now go to Rocket Lab. And so now I'm going to pivot into you don't have to only buy the UFO ETF. You can also make your own basket of stocks. And that is what we've done in Turbo. Same with Growtection, although Growtection owns UFO. And so, there's many different names in this theme, and you don't know which one's going to be the best performer. It's always hindsight. You can give yourself the best chance trying to buy the stock in the sector that has, the best liquidity, the best fundamentals, the best sales growth, institutional support. But again, you still don't know if that's going to be the best performer. And in these themes, there's always, subsectors and different areas of the theme. It's not just only space. There's many other stocks that move with this theme. And so the way in TurboTection we've been playing this is right now we have 4 different space names that equal a 12.5% allocation to the portfolio, and Rocket Lab is the biggest one at about 6% size right now. And you can see we bought this one out of that Power 3 setup in the base, and it's had 2 strong expansion days. And Rocket Lab in the whole space theme is like the launch and spacecraft manufacturing name. So that's kind of the sector that this one covers in the space. And this is also kind of the liquid leader, I would say. It's got huge liquidity. It's been on many really nice runs throughout the past years. And it's really one if a big institution wants into space, Rocket Lab is typically the go-to one. So that is Rocket Lab, and that's the biggest weighting. And then another weighting is SATS. And now this is a satellite operator and connectivity. So a little bit different than Rocket Lab, but it's still operating in the overarching space theme. And this one's about a 2.75% size. And we bought this week trying to come out of this base. And this one looks really good for continuation if it can, fall through out of this pattern. And then Planet Labs, this was purchased yesterday at 2.5% size. And this one is Earth observation, data, and analytics. And you could see it had that breakout day yesterday on a nice volume, and now just putting in a high inside day, resting a little bit, which is totally normal. And then the smallest position in the space basket is Lunar. This is about 1% size. And this is just basically, a missions contractor. And you can see this one is green on the day, making a new high today and super strong. This one's more of a high-octane name, so it's got quite a high beta, very volatile, and that's why it's weighted lower than some of the other ones. And you can just see, looking at the performance of all of these different names, some are red, some are green, and that's just how themes work. You never know, you know, you don't know which one's going to be the best, and it's always hindsight, and that's why taking a basket approach can be helpful. And they are all correlated. So when space sells off, they all can go down together. So you're not eliminating risk by owning all four, but what you're doing is you're reducing single stock risk while also increasing your chances of catching the leader, because if one is lagging, we can cut that and use that capital to add into one of the leaders. And really the bottom line is, same total exposure, less blow up risk, and more ways to win within the theme versus just say you want, that 12.5% allocation to space, not just going all in Rocket Lab because, what if that stock dropped an offering and it gaps down 10%, but some of the other space stocks, are continuing higher. You had the right idea, but you just picked the wrong stock. And that's why, if you have your target allocation size that you want to get into the theme, using approach of sprinkling in different names and then adding to the winners and cutting the weeds, and that gives you a better chance to get positioned in the leader. And this is an example on space, but this works in all different areas of the market. Memory, optics, semiconductors, it's all the same principles. Just using space because they've been strong, and it's a real world example in the TurboTection portfolio right now.
The basket discussion, I'm taking a similar route in in Grow with PL and UFO, as you mentioned, and as far as the optics names go, owning three of the big four in smaller size, own GLW, Sienna, and GLW, Sienna, and Light. AAOI do not, but smaller size, really look at the three of them as being one sector position. Great stuff, Connor. And some of these that you talked about that you're in, they're just coming out of the base now, not really extended. And Rocket Lab still forming the right side of the base. And you're absolutely right. That's the liquid leader. Let's talk quickly about some of the enhancements to Market Surge that I like. This new Market Surge upgrade. They've got the 3 and the 6 month relative strength easily displayed here, as well as the relative strength line and the year-long relative line. And two metrics that we talk about all the time are displayed at the top here: the 50-day average daily dollar volume and the 21-day ATR percent. Key metrics that we look like all the time. Really like seeing these on the main screen. Thanks, Connor. Let's go to Ted now, and he's going to talk about some data center infrastructure and component names that are acting very well. Take it away, Ted.
Thank you, Don. So I just wanted to have a podcast section on 3 names that we missed off the lows. Just really couldn't find ourselves in entry, but still haven't missed them in the grand scheme of things. Still in big bases or just a little bit out of bases. But the first one is Coreweave, and shout out Todd. He actually got this one on that big downtrend line break. And once Coreweave announced some more multi-billion-dollar compute deals, it put in highest volume ever. on like a few days ago, like 4 or 5 days ago, and from there, to me, that's just what got me on the radar. And coincidentally, at the same time, it reclaimed the 200-day moving average as well. So you can see this huge range that Coreweave's in. We haven't missed it at all. You can say we missed it off the lows, but I always like to keep Livermore's quote in my head, which is, you don't have to catch the first eighth and last eighth of the move, and oftentimes those can be the most expensive just because there's a lot of volatility that comes with that first part of a move and the last as well. So this is one we're looking at. It's one of the main players in compute, and all these frontier model companies are starved for compute. They need more and more. They can't get enough. The infrastructure is lagging behind in terms of building it out, building the data centers out, the energy infrastructure, getting the chips, the networking, the opticals all into the data centers. Definitely at the forefront. I believe Jensen Huang said it wouldn't be possible to push out all this compute without CoreWeave. So this is one that we're watching. If you look at the weekly chart, and this is a name we've traded in the past too, but this is one we want to get on board. Yeah, one of the dominant players in the compute industry. Another name, the second one is NBIS. Another name we've actually traded in the past as well. Just a monstrous 6-month base. On a previous podcast, I believe it was last week, I compared this to the SMCI and MSTR precedent. Well, this is not exactly the same now since we blasted into new all-time highs. But if we can start pulling back here, it can kind of like similar to the MSTR one where we reached all-time highs and then built a flag. So this is kind of what we're looking for. This 140, 150 area. Don, is that a moving average right there? That red one? Is that the 8? Or
That's the 8E.
That's the 8, right? Yeah, so
Yep.
potentially at the 8, we would take a starter, especially if it retested the 141 base pivot. But one thing we're aware of is that earnings is in about a week and a half. So that does make it tricky for us to initiate a new position and hold into earnings. So depending on what the chart looks like, we might just have to wait until after earnings and maybe buy an earnings gap or some sort of continuation setup afterwards. And some might wonder, there's no earnings in this name, but why are we interested? In the modern markets, we've found, and we've kind of revised it ourselves at Revere, we don't always require earnings like the classic IBD William O'Neill system. If you look at the sales change, Don, if you highlight that 2025, 2026, 2027, just triple digit revenue growth. They're also a key player in the compute industry as well. And they've received many billion-dollar partnerships for compute over the last 6 months. And this is why I really like the 6-month basis. Oftentimes you'll have this big run up and the stock gets extended from, I guess it's quote unquote fundamentals and its valuation. And then it goes through this digestion period. And during the digestion period, that's just where institutions are accumulating if they believe in the company. Oftentimes as well, there's a lot of good news that happens within the digestion, which is what we saw in CoreWeave and NBIS. Eventually, the pressure of the market is lifted and institutions just continue to accumulate. Eventually, there's more demand than supply, and that's where you get these takeoffs and breakouts in these stocks. I believe before the correction, I covered this last week, there's those 2 gaps. Both of those were deals for compute to expand infrastructure. It got pulled back by the market, but it held the 200, built a higher low, and then went again. We know what happened with the markets now in hindsight, but if we V-shaped, NBIS as a leader, held up strong relative strength, was holding up too, and we blast off the new highs as well. So we're just looking for some sort of flag here now to get ourselves involved. And then the last name, another name that we were in and out of in Turbo before, and it really just chopped us up a little bit, was Intel. It digested in this multi-month base, and again, it undercut that 40-ish area and just slingshot into highs with the rest of the semis and semis equipment names. There's a huge demand for chips and also massive scarcity as well. So these AI companies can't get enough of it, and they just need more and more and more compute. So this whole industry, the compute industry, chips, optics, memory, all these themes are just exploding higher after this correction. So these are 3 names that we missed off the lows, but we're just looking at them, stocking them, watching them to see if we can find an entry.
Good stuff, Ted. Some of these moves off of the low have been just amazing. Intel from 40 to 70 in about 2.5 weeks. Great stuff. All right, Todd. For about a month ago, we started talking about edge AI companies, and we know from watching the market over the last month, what goes down can bounce and go up, but what goes up can reverse and go down. And that's why stops are so important, especially on individual names. We'll take a look at some that were leaders, got taken apart, and now are possibly looking to regain their leadership status. And let's start with Fastly. Take it away, Todd.
All right. How fast things change. One of the new bright spots in AI quickly turned to a questionable situation last week and also post follow through day. And basically, this is why we have rules. This is why we have stop losses. And this is why Revere comes in every day with a game plan and an exit strategy, because you never know when one of these situations is going to hit, especially in AI and software. Just to set the background, last week, these stocks all severely sold off on Anthropic's new release of their managed agent product called Claude Mythos. And the big concern here is that if AI workloads and traffic are optimized inside these new models, then this could disintermediate these content delivery networks, which had this security backup edge that was supposedly going to be instrumental in the rollout of agentic AI. So basically, this announcement shows that Claude is trying to bring this security function in-house and tackle this on their own. And I want to talk about a couple of key rules here that we follow. You can see Fastly has been a very strong trending stock. TurboTection bought it out of the earnings gap. We, had a lot of offensive sells along the way, but ultimately our line in the sand was a break of the 21-day exponential moving average, which hit last week. We went over this, we used the 7-week rule on this, where we want to sell on the first break of the 21-day moving average, not that first day, but on the second day when it breaks the lows of that situation developing. And we saw where it did break the 21-day moving average, and then the next day it fell through those lows. So we exited this trade around, that triggered around 26 and change. That incidentally also coincided with a trend line break of that lower channel as well. So several sell signals were triggered on this particular trade. We exited our last position, no questions asked. And, a couple other things to note is right at those highs, we were almost 200% extended above the 200-day moving average. We were almost 3 average true ranges extended above the 21-day. So it was very extended, but this is something you don't really expect to happen after a follow-through day, is one of these leaders to fail this rapidly. But we have to be prepared for it, and we were prepared for it and got out of it. Now, in the grand scheme of things, it's still holding the 50-day moving average and that 10-week moving average. There could be some life left in this, but that was over a 40% drop from the highs to the lows. So that's very hot, not the way you want to see a stock pull back to the 50-day moving average. And incidentally, Fastly is the one most exposed of all these three names to the disruption of the Mythos model. Now let's just quickly look at Net, which was another name that we had highlighted. Net just couldn't stay above that 50-day moving average. It was a stock we highlighted as a big player in this arena, and it just simply broke that 50-day moving average. Has just recently gotten rejected on that 50-day moving average yesterday. So again, not a stock that's on our watch list anymore, and completely violated the 50-day, which is off the table. And finally, let's just look at AKMI, which is really the largest of the content delivery networks. And this was looking very promising. Again, Fastly was a leader and the stock that we had the highest hopes for, but this broke that 21-day moving average on the same day, and then broke the 50-day moving average, and this trade was off the table and is off the table at this point. So as of now, really, there's only one true survivor, and that is DigitalOcean, which is another play we talked about. And of those 4 companies, DigitalOcean is probably the best looking that is left in this area. And then we'll see if Fastly holds that 10-week moving average. So again, just want to stress the importance of why we use stops here at Revere, and why we have a game plan every day.
Great stuff, Todd. One thing I want to point out with Fastly is very often when you break the 21-day and you come down to the next level, which is the 50-day, and bounce there, you want to watch what happens when you come into that declining 21-day moving average. And right now, that is very clearly acting as resistance. This is the green line on Fastly, where it failed today and now has reversed. So regaining that, and then seeing the 8, that's the purple line, seeing that hook up and come back up through the 21 along with this, maybe part of this building a new base. On the other hand, if Mythos, the decision is that this Fastly's not going to be the leader that it was during this, and this is really a big key. Ride these things along the 8 EMA as far as you can take them. Hard break of the 8 EMA, watch the 21, break of the 21. If you have huge gains, you can watch the 50-day, but who wants to sit through a 40% pullback from the high all the way down to the 50-day moving average? That's crazy. So we take more advantage of the 8 and the 21. Those are the riding above there is really when you get the best outperformance relative to the index. Breaking those, get out of the way, because there's either something wrong with the stock or something wrong with the overall market. Great stuff, guys. As usual, really appreciate that. And we're pretty much done from the tech side. We're at right near highs of the day as of 12:15 Eastern time. So that means it's time to turn it back over to the spirit of Dan. He might not be here, but he's always here with us in spirit. And take us on home, Dan, spirit of Dan. Thanks, Don. If you like what you heard, tell your friends, tell your family. Go to revereasset.com. Watch our nightly videos. Join us on our podcast, because the name of this podcast is Your Money, because it's not their money, it's your money. We'll see you next week on Your Money, because it's not about how much you make in the markets, it's about how much you can keep.